Okay, welcome everyone. We're doing another fund manager interview here on Coffee Microcaps, and I'm delighted to say I'm welcoming back a regular presenter here, Luke Winchester, portfolio manager, CIO, analyst, all-round investment team operator there at Merewether Capital up in Newcastle. Luke, how are you, mate?
I'm good, mate. I'm good. Yeah, unfortunately, no one else to blame if things go wrong with the portfolio. I've got all the hats on, so no, things are
Good,
going
good.
well. Things are going well.
Yeah, performance has been going well. I'm following the newsletters. Been a good 2024, I think, overall, for Merewether and the microcap space more broadly. I think it,
Yeah,
hasn't been a vintage year, but definitely a good year.
yeah. Obviously, a couple of weeks to go, so let's not get too far ahead of ourselves. We know how quickly things
I'm
can
banking on a
change,
Santa
but
Claus rally here, Luke.
oh, fingers crossed, yeah. But no, up 40 odd percent for, year to date. And I agree. I was just thinking that before coming on, because I know we always like to talk about the broader market and what we see. And I agree with that sentiment. I think, there's pockets of exuberance in other parts of the market. And certainly, you look to crypto and all those things going on. But we haven't necessarily seen that in this micro and small cap end of the market. But things are fine. And for me, the thing I always use to judge is if a business is reporting well, updating the market well, growing strongly, is it being rewarded by the market? And I'm still seeing that. Most stocks that are doing well, there's some good fundamentals backing that up. So, if that continues, I think that's a good market for everyone like us to be involved in.
Yeah, and I think, one of the things we've definitely seen in the market as well, is, a lot of M&A in the microcap space, a lot of big premiums,
Mm.
70, 80% plus. So, I mean, that also kind of tells you there's kind of a positive sentiment of where these businesses are trading operationally at least. Valuations mightn't have maybe caught up to on the listed environment anyway, to where a lot of these PE firms and indeed competitors think a lot of these microcap companies are trading at.
Yeah, of course. Yeah, spot on. It's been a big driver of returns for people who've been in those companies, and you've seen some big premiums. Fingers crossed if interest rates start to come down, that may make things, smooth things for future M&A. And the other one as well is the Aussie dollar where it is. You've seen quite a few, particularly US companies, leveraging that currency to acquire Aussie businesses. So I think that's a theme we'll see into next year as well. I think M&A at large premiums, you'll see that continue basically until you see that catch up between sort of small to where sort of the mid and large cap companies are valuation wise.
Yeah. Well, let's get into it with our two stocks that you've picked out of the portfolio for today. The first one is Change Financial, ticker code CCA. We've had them on once before. They came in just after August reporting season, early September, and I'll put a link to their presentation in the description below on the YouTube video. But for anybody who maybe didn't catch the team in the September event, maybe just give us a quick 101 on Change Financial and what they do.
Yeah, so Change Financial, they operate in the payment space, digital payments. It's a very broad space, and I think what makes Change Financial a little bit sometimes hard to understand for ASX investors is most of the time for the listed companies we've had on the market, the digital payments companies have been focused on the merchant side of digital payments. SmartPay, Tyro. Those sorts of businesses. The closest comparison to someone like a Change Financial on the listed market is probably someone like an EML. Cuscool has recently listed, but it operates in the back end. It supports the financial institutions that offer digital payments to their customers, and Change also can do that on their behalf as well. So I think there's a little bit, yeah, it's a broad space, that digital payment space, and most players try to get scale across the whole ecosystem, targeting targeting consumers, targeting merchants, and trying to be a one-stop shop. Whereas Change, I think, has found a nice little niche supporting primarily small financial institutions and startup fintechs for their digital payments programs. So that's the business in a nutshell. Obviously, I do encourage to go and watch Tony's presentation on coffee microcaps. I've got a blog post on the Merewether website as well. It can be a complicated space, that digital payments, but nonetheless, I think they've got a nice niche, and realistically, obviously growing within that niche is important, but I think one of the things that attracts people in general to digital payments is, the tailwinds for the industry. We've seen it now over many, many years, the shift to digital payments. And then on top of that, of course, you get a natural increase in from inflation and things like that as the value of goods and transactions grows. So there's a few things I like about Change, but in a nutshell, that's the business. It's providing that processing technology for digital payments.
Yeah, the real kind of nuts and bolts, kind of behind the scenes, rather than, you're going to see it as either a consumer or as, somebody who runs their own business. You're not really going to be interacting with him. So I always find those kind of businesses are also a little bit difficult for people to get their heads around, because they can't ask their mate who might be like, using the service if they run a business, or, they don't interact with it themselves. Can be a bit tricky to get your head around. So I think, yeah, check out the blog post and the YouTube video from when they were on with us in September. But not just an Australian business Change, they're operating in the US as well, which is again, not something we have tended to see in the payment space. At least in the listed environment, it's a lot of Australia, New Zealand focus rather than, looking outside to, the US or the UK, whereas like Change is, really an international operation.
It is an international operation. That came about. So a few years ago, Change bought the assets of Wirecard Australia, which came with basically an Oceania business, Australia, New Zealand, and some Southeast Asia. The history of Change itself before that acquisition was an American business. And they didn't lose that for a while. They kept their footprint over in the States, and basically took the payment processing, card issuing business, and tried to expand it over into the US. They've recently come out and pulled the plug on that. The reason being is, the regulatory environment over in the US has become quite strict. Basically started when Silicon Valley Bank collapsed.
Mhm.
That wasn't a direct result of the emerging sort of fintech space and digital payments, but I think in general caused US regulators to take a look across the spectrum. And so, as an example, what previously had taken someone like a Change or one of their peers circa 150 days to get a customer from zero to having an operating card program, has ballooned out to 200, 250, and some of their large peers in the US have been hit quite hard by these tightening of regulations. So Change has announced that they've pulled out of the US. It's going to save them about 1.5 million USD a year, and we'll talk about the financials in a second and where that leaves them. But as I wrote in my last monthly report, I was quite encouraged by that. I mean, the US, obviously, the blue sky potential of the US is huge, not just obviously the
Mm.
size, but they are much earlier in that digital payment transition. Australia, it's one of the rare industries, digital payments, where we can actually use Australia as a example for the rest of the world, because we are significantly, as a handful of others, but Australia is one of the real leaders in digital payments and the acceptance of that. And so, we can sort of see that trajectory in other countries that we've already seen from sort of 10, 15 years ago. So I completely understand why they tried to, stick around in the US. And I had some customers there, small fintechs and some programs, one that was in the market, two that were, going through the regulatory processes. But I sort of praise them for not getting caught on the sunk cost bias of, we've been there for a few years, we've invested a lot of money there, we've got customers there, let's stick it out through this tough operating environment. They've made the hard decision to pull back. And of course, they've got the approvals, they've got the platforms, they can go back into the US when the time's right. But I think for the time being and the current, especially we talk about the conserve that cash and that profitability was the right one. But nonetheless, as you said, still a global business, primarily now Australia, New Zealand, but some Southeast Asia, some Latin America as well in small amounts, and previously the US, but now pulled out.
And yeah, maybe if we kind of touch on the results. I know it's a while ago since they presented, which was the full year results, but we've had one or two updates from them. We had the AGM, and maybe just talk, where the business is at and kind of what you're kind of looking for now as we, push into 2025. We'll have more results for them in back end of February sometime. Yeah, maybe just give it the state of play on where they are financially.
Yeah, look, so they're right on that interesting inflection point where you're right on the cusp of profitability, cash flow positivity. So second half last year was a small EBITDA profit. There is some capitalization of development in there, so still lost a little bit of cash, but trajectory going in the right direction. But the guidance for FY25 was 30% revenue growth, and of course, the other reason why digital payments is an attractive business model is it is quite scalable. You have that genuine platform business, and each incremental customer, once you get past the gross margin costs where Mastercard and others are, clipping tickets for services, it's very strong incremental cash and profit. So 30% revenue growth, that should fall quite well, particularly with pulling the costs out of the US. So they've guided to be EBITDA positive. Look, they'll incur some restructuring costs in the US. So from a statutory point of view, where that number comes in, I'd hope for somewhere maybe around sort of $1 million EBITDA FY25. Wait and see. That can obviously move around, and we'll move around with the cost base as well. It's still a growing business, and if they see opportunity to deploy, some additional OpEx into sales and marketing or opportunities, I expect them to do that as well. But right around that inflection point where I think all businesses, particularly microcap businesses, become really interesting because the market, when it focuses on the statutory numbers, can often miss the operating leverage that can come once you get through that inflection, and those incremental dollars can really hit the bottom line. So yeah, first quarter update, they do report quarterly, which is nice. They're actually run rating sort of decently ahead of that 30% revenue growth. I sort of suspect the second quarter they'll have a full run rate of customer rollouts that happened during the second quarter. Oh, sorry, during the first quarter. So I think you could even see an upgrade to that revenue guidance and maybe a refinement of that profit guidance as well. So no, I think the business is going quite well. And like I said, I really like businesses around that sort of profitability inflection when I think that scalability is going to come in quite strongly.
Okay, great. And yeah, hopefully we can get Tony and the rest of the team back in end of February, early March to give us an update once the kind of full results are out. Another one, kind of a new one to me, actually hadn't looked at it, is Cleanspace Holdings. Let me just confirm the ticker there. CSX, so Charlie Sierra X-ray. Definitely hadn't had him on to coffee microcaps in the past. I'll put him on my list for 2025. So please give us the 101 for myself and everyone else.
Yeah, no, I always like sort of finding new ideas that you don't see many people talking about. Yeah, so these guys, look, they've had their head down for a couple of years. It was a bit of a high-flying IPO back in late 2020 with COVID. They do powered air respirators, so masks in effect, but masks that are connected to a pump that filters, pushes air to the users. So not just a paper or cloth mask. And primarily that business, it came out of the founder of the business was ex-ResMed. And the inspiration for starting Cleanspace was originally taking the technology from ResMed CPAP machines and applying it to the industrial PAPR market, powered air purifying respirator. So the business, grew quite steadily. I think it founded in 2012 or something like that, and it grew steadily for a few years. Had a nice steady base of industrial customers, and they pivoted to healthcare. And when I say pivoted, sorry, they released a product targeted to healthcare, and the timing of that couldn't have been better. They released that product in 2019, then of course, COVID in early 2020, and so you saw this explosion of sales to hospital and healthcare customers, and um, that led to a few things, which all of them have ended up being long-term problems for the business and the stock. So first of all, they IPO'd on the back of that. They IPO'd on the back of revenue going from circa $12 million a year to 50, 60 million and being
Mm.
incredibly profitable at the same time. And then, of course, as we've seen with a lot of businesses through that COVID period, that restocking, destocking of inventory through a supply chain was very much a victim of that. So, hospital customers were given government subsidies they were panic buying respirators. And speaking to the CEO, he estimates that 80, 90% of the respirators they sold to hospitals never made it out of the box.
Mm.
But hospitals had money to spend for respirators, and so that Cleanspace was selling them. Anyway, so definitely a broken IPO. Anyone brings up the chart, the stock, floated at $4 something, went to $7 within a few weeks, and then, over the next 2 years, crashed to 20 cents. $7 to 20 cents. That's the reason why, no one's really looking at this thing or has heard of it. I mean, it's the sort of chart you assume it's just a terminally declining business that will just, slowly work its way towards its death. Um, but under the bonnet, and I always like these sorts of investments when I think that's the perception of the market's perception of the business, and when I take a look, I think there's potentially something different there. So when the healthcare revenue exploded, previous management pivoted to that, and so they previously sold their industrial respirators through industrial distributors, third-party distributors. So that was a very sort of operational cost light way to do business. Selling to hospitals, though, they sold directly, and so they really ramped up their cost base from circa 8 million to 20, 26 million or something like that. Really beefed up sales and marketing and support and training, all these sorts of things. Um, and so when the hospital sales fell off, you've now got this elevated cost base. $15 million EBIT turns into a $16 million loss, and why would you want to own the business? Well, after realizing the mistakes of that pivot to healthcare, and I think, look, you know they now understand that the use of powered respirators in hospitals, it's a very edge case use. Unless there's another pandemic, I don't think you'll see any significant healthcare sales. They've pivoted back to industrial, and over the last 2 years, they've got that industrials segment back to growth. It's grown about 35, 36% over the last 2 years. Um, and to the point now where, FY24 was essentially all industrial. There was negligible healthcare sales. The business, like Change, and like I said, I like to find businesses near this inflection. Fourth quarter of the year was EBITDA break even, and July in particular, and July was as well. So you're starting to get through that inflection point where that industrial growth has now overcome healthcare. The business is scaling into profitability. Um, no eyeballs on the stock. It sort of ticks a lot of those qualitative boxes I like to see. So um, that's the quick picture. Sorry, when I say quick, I know I went on for a few minutes there, but that's the background to the business and the investment. Yeah, I think the key thing there is for me, and I've written this before, it's trying to identify the difference between, like a broken stock and a broken business. And I think oftentimes you'll see, stock prices where people are looking at the share price chart and, not quite looking through the actual business. And I think when you do that to Cleanspace, there's more than meets the eye.
Yeah, so I kind of term it slightly different, but I say, there's a good business in there somewhere. It's just not kind of being reflected maybe
Can't
in the
see
stock
it.
price or the maybe even the
Yeah.
operation performance. Sometimes it needs,
Yes.
new management in there to come in. In terms of the use cases for their product. I'm thinking, is this in, hazardous work environments like, like really hardcore industrial manufacturing places, or guys who are on biohazard cleanups, if there's chemical spills, or is that kind of the use case for these, let's call them advanced personal respirators, I guess, as opposed to just wearing a mask, one where you actually like need a proper filtered system. Is that kind of their use case?
Yeah, yeah. No, it's a really good point, and it's a super interesting industry. I think as generalist investors, it's always interesting. You find these businesses in a niche where you'd never think about, hey, what is this industry and how does it work? And then you do some work into it and you realize how interesting it is. So when it comes to actual filtering of particles, it's 99 point, 7 or whatever it is, percent effective. But that's basically in line with your N95 masks. So from that point of view, by far, you talk about the broader mask space, the biggest competitor is just an N95 because it ticks the box as far as filtration goes. But even though there's been a lot of studies that show those sorts of masks, they don't actually hinder oxygen intake or things like that. I think mentally, and we've all experienced this now through COVID. When you've got a mask on for a while and you're breathing in your own hot, just it's just not
Mm.
pleasant. So the areas where you've really seen powered air purifying respirators take off is those exactly as you said, those hazardous areas where you're wearing a mask for hours on end, and that's why healthcare failed because you could chuck on an N95 for, 15, 20 minutes, and then once you were taken off, and you didn't need to have a clean space on the whole time. But we underground mining, welding, chemicals, asbestos, silica, dust, these are the sorts of industries where, yeah, they're dominated by powered air purifying respirators. And then, of course, again, you do some work and you sort of realize the difference. So their peers, the biggest peer by far is 3M over in the States. They have about a 40% market share globally. So you're up against a big gorilla, which I think, you know, scares a lot of people off, and rightfully so. I mean, in most industries, you know, scale and size is a advantage that a lot of small upstarts struggle to overcome. Um, but most of their peers operate a very basic powered air purifying respirator where it produces a constant flow of air. It's a fan basically producing constant flow of air. And they produce about 180 liters of filtered air every minute. And to do that, you've got a unit that weighs 3 to 4 kilos. You usually have to have that mounted to a belt or a backpack and then run tubes up into a mask. The innovation from Cleanspace, which comes from the background at ResMed, was they said, well, why don't we use smarts to only power filtered air when the user's breathing? So it measures the change in air pressure, which as you breathe in and out, air pressure changes. And so it only powers in filtered air when the user's breathing. And it ramps up based on how hard that user's breathing as well. So by doing that, they bring that filtered air down to sort of 50, 60 liters of air a minute, depending on how hard someone's breathing, which means they only need smaller fans, smaller battery, and in general, a smaller operating unit, which is down to circa 300 to 400 grams. So by doing that, it can fit. You look at a Cleanspace picture, it sits on the back of the neck with a sort of a head harness back of the neck. And it just allows for better mobility. You don't have something tied to your waist or your back or whatever it is. So, the work that I've done, people I've spoke to, they have a really good product, a really, really good product. Now, that's no guarantee. There's been plenty of businesses where a good product doesn't equal, winning a segment, particularly against a big behemoth like that. But it gives them a fighting chance. You've seen that steady growth over the last couple of years. The AGM update was a bit weaker than expected. They'd originally guided to 30% growth in FY25. To start the year, sales have been flat. Changing the CEO and things like that. They still have lumpy ordering patterns and things like that. So, judging the business on a 3-month, 4-month period is probably not right way to view it. I still think the long-term, potential and trajectory is there. And as I wrote about in the last monthly report, what really attracts me to it is I sort of take this view of, okay, if I think this business can grow its revenue at circa 20, 30% a year for the next 2 or 3 years, what does that look like? Should this business scale and show profitability? And for me, 72, 73% gross margins is a huge start for a
Mm.
business like this. Like I said, using distributors for sales, marketing, support, training, operational cost light. You've seen that as they've taken costs out of that cost base. Um, and so I think, this is a business where if that growth comes through, you'll really see those EBIT margins start to explode. And as I pointed out in my monthly report, you've actually seen it. A couple of years ago when you had that explosion in healthcare, the business did 45% EBIT margins, which is pretty world class for a manufacturer. Now, some mitigating circumstances there when you got customers panic buying respirators, but nonetheless, I think those economics are still roughly, they weren't selling the respirators at a premium. They were still around that gross margin and stuff. So yeah, no, super interesting segment business and niche, and one, like I said, I like the idea of that mental exercise to say, well, if I think the business can do this over the next 1 or 2 years, what should that look like? And as I sort of wrote, I think this business could easily do sort of a couple of milli, but into sort of FY26 if you're modeling a year or so ahead.
And the resetting of the cost basis, all of that kind of filtered through the numbers now, or is that still an ongoing process into FY like 25? Are they still like trying to, you know, right size the business to the kind of revenue profile that they expect?
Yeah, no, really good question. So when they listed, they raised a ton of money, which, for all the flaws of the IPO, that cash balance really saved them. Like, they haven't had to raise
Mm.
capital since. Obviously that cash balance has really dwindled down to circa 8 mil where we are today. But when they listed, they really bulked this business up from an OpEx cost base point of view, but also ramped up their manufacturing capacity to go to support $100 million in sales. Um, so, speaking to the CEO, I think most of that right sizing is done. Manufacturing capacity, they've sort of, brought that back to circa 50 mil, which, gives them sort of 3, 4 year runway. Um, Most of the OpEx is just taking away the direct sales and marketing boots on the ground they had into hospitals and redeploying that into industrial and sort of and pulling that out. So I think the cost base is pretty much not fixed, obviously. It will
Mm.
slightly grow from here, but it's circa 1.2 million a month or something like that. And I think that's a good number. At their FY24 conference call, the former CEO, now chairman, he came in as Graham, who came in as an interim CEO, has now stepped back to the chair. He made the comment that, yeah, basically that comment that the cost base is now right size, targeting that 30% revenue growth. And they think to achieve that growth, needs costs circa to grow 5, 10%, which, back of the envelope, how would I think about this business growing feels right to me as well. Like, I don't think it's a business that needs to put on, millions of dollars in operating costs to grow strongly, as long as they're able to bring on good distributors, ensure that those distributors are trained well, incentivized well, engaging the end users. I think they can grow and keep those operating costs quite modest.
And sales, are they? I'm guessing this is, got a global footprint potential. It's just about finding, the right distributors and targeting the kind of right markets. I'm thinking like, a place like Germany that's got like a huge, heavy industrial manufacturing type industries, would be a key market as opposed to somewhere like a Singapore or somewhere like that in Asia where there isn't really a manufacturing industry, so to speak. So maybe just give us a sense of main markets for them? You know, is a weak Aussie dollar good for them? Is it kind of neither here nor there to current business?
No, weak AUD definitely helps. They manufacture here in Australia, so most of that cost base is in AUD, and obviously revenue in global currencies. So yeah, no, it's a global business. I think it's super interesting. Businesses who sell through distributors because there's a temptation as possible, and just get inventory into as many different places as you can, and what sells sells. And I think chatting to the CEO, I really appreciate they're quite targeted. So right now they're focusing on six key markets, which is Australia, the US, the UK, France, Germany, and another European country, which is escaping me at the minute. But focusing on six key geographies. They've got plans to tap into Southeast Asia, primarily Japan, but that's again sort of a medium longer term trajectory. But yeah, no, look, as you said, the key is finding the right distributors in the right locations, making sure they understand your product, how it compares to its peers, incentivizing them well to sell it, upsell it, push it, provide support training where required. And then from Cleanspace's point of view, it's basically brand marketing, just trying um, to that end customer. You're not necessarily trying to sell them directly, but being at trade shows and sponsoring trade magazines, things like that, trying to get the brand out there. Um, so no, definitely a global business. I think Australia has been a good segment for them, still growing. I think they disclosed it was still growing double digits to starting FY25. But you look at the potential of the business and go back to what we're saying about change. I mean, the US is the big market here. They've done quite well in France and Germany and the UK, but those markets they pale in comparison to the US. So they restructured the US sales team only a few months ago. The old team was healthcare focused, and speaking to the CEO, they tried to pivot to industrial, but they just didn't have the networks, the
Yeah.
relationships, or the ability to really drive it. So they've now got a senior vice president with an industrial background. He's hiring a team, three or four will be under him, servicing sort of west, south, north, and east. And yeah, really driving that industrial style business now. And I think that's the one, you know, as we sit here today, I think the business can do well. Don't get me wrong, from the current valuation and everything like that. But if you say like, the real blue sky of something like a Cleanspace is if they can really get the US humming and grab a bit of market share over there. It's just a substantially bigger market than what we have obviously here in Australia, but even Europe as well.
Yeah. And I mean, I mean, you mentioned ResMed there. I mean, Fisher and Paykel, has risen up to be, a very solid competitor to ResMed, even though, ResMed had a big head start on them and was kind of the global leader. But, it shows that, you can have two very kind of similar products, but, you'll find a customer base for both of them. And I like the fact that it's a lot lighter than the 3M model, notwithstanding, what a great brand 3M is to be kind of going up against. But I just recall the famous Peter Thiel talk where he talks about, 10Xs. So your product needs to be 10X cheaper or it needs to be 10X better to, really disrupt the market. And I mean, if you're talking 500 grams versus 3 or 4 kilos, well, there's your 10X, give or take, in there.
Mm.
So, I'd rather definitely, if I was a user, not be lugging around 3.5 kgs extra every day as opposed to lugging around something way lighter.
Mm, mm. I'll be lugging around 3.5 kgs extra after Christmas, mate. So,
No,
but
exactly.
no, it's a really good point. Actually, I forgot to touch on that. So yes, from a feature point of view, I think it's when it comes to pumping air, it's just as good as peers. Obviously, being lighter is the competitive edge there. There's also a bit of smart. The machines are Bluetooth enabled, and so go back to change. I don't like investing thematically or from a tailwind point of view, but you always like businesses that have the wind at their backs. Finding
Mm.
businesses that are struggling against that, I think is always hard. There is a general trend towards operational health and safety globally, and not just at a individual level to ensure people have correct PPE and everything like that, but filtering that up to manager and board levels to make sure reporting, that there's a responsibility of reporting through an organization. And so, Cleanspace's device has that reporting function where it can go through to the end user, gets a report on whether the mask's working properly or not, fitted correctly, the filter needs replacing, the battery, what level is up to, all that sort of stuff. And then also reporting to managers and however the organization sets it up, but getting that work health safety reporting. And there's just big tailwinds for that. Western nations in particular, speaking to some people, and the way it was put to me, from people who work in sort of finance for some engineering construction style companies, is that if someone comes to them with a PPE request, it just gets approved. Like there's almost no pushback to people purchasing PPE and making sure that work health and safety is front of mind for everybody. So I think there's a lot of things that sort of give them that little bit of a competitive edge of the product, and it's priced. Again, there's a spectrum as to but compare it to 3M's sort of top of the range models. Yeah, it's about 10 to 20% cheaper as well. So there's a lot of reasons why I think they'll be able to sort of get people to test the product, try the product, and hopefully once they do that, you convert some market share over. And these are from where we are today. If you know, again, I hate thinking about huge TAMs and whatnot, but if these guys can grab 1-2% market share of a huge PAPR market, we'll do very well as shareholders.
Yeah. No, it's definitely I'll put it on the list for 2025, and maybe we can get the team in at some stage.
Yeah, well, sorry, I meant to say before. So Graham, who stepped in as the interim CEO and sort of engineered the turnaround, he's now stepped back to chairman. And only last week they announced the appointment. I should have went and checked the name; it's currently escaping me. But they brought over a 3M executive who was their head of Asia Pacific for health
Mm.
safety. So very good resume to bring into Cleanspace. And perhaps she, one of her first, investor relations things for the new year could be a coffee microcaps presentation.
Yeah, maybe once she's got her first result under
There you
under
go.
her belt, we'll see if we
Yeah,
if we can't get her in. Luke, thanks very much for joining us once again. And yeah, two names we'll definitely keep an eye on as we head into 2025.
awesome. Thank you, mate.
And yeah, as Luke said, I'll link to the blog post in the description below for Change and for Clean Space, and I'll put the link to Change's presentation back in September down there as well. So if you want to do a bit of extra legwork over the Christmas New Year, the links will all be there. Okay, thanks, Luke. We leave it there.
Cool. Thanks, mate.